Let's go into module 7. So this is all great, but you might be wondering, this is cool, but I don't even know what companies I should be investing in. All right. I showed you guys my watch list. I'll show you guys again. Most people, when they're doing options, they like tech companies because it's volatile. All right. And a lot of times the value business, the value companies, the reason why they're value stocks is because nobody's paying attention to them most of the time. So if nobody's paying attention to them, it's hard to sell options in. So value investing, although it could work, right? Like you can see a tech company that the PEG ratio is screaming undervalued, and there's still some volatility. There's still some volume in there as far as options is concerned. Yeah, that's a win-win-win-win, right? But nonetheless, I want to show you guys how to how to evaluate or how to analyze companies. Now, like I showed you guys, here's my watch list, and this is always evolving. Google right now is undervalued in my opinion. A lot of people are scared with AI that Google's going to get crushed, but Google's a huge company, guys. You have HIMS, Hood, NVIDIA, Palantir, QQQ, SoFi, Tesla, TSM, and VOO. All right, that's my watch list. You don't need to copy me. You need to come up with your own. But if you want a good start, you can start with that. So how do we analyze these companies? This is the great business checklist. All right, check it out. Here's the traits of a great company: strong and growing revenue, high return on equity, 15% or more is the sweet spot, consistent profit margins, low debt relative to cash flow, brand strength or economic moat, excellent leadership and culture. If you'd be proud to own 100 shares forever, it's a great candidate. Apple being one of those probably for you. Tesla is one for me. Microsoft might be one for you. Coca-Cola might be one at the right price. There's a lot of brands that you use every day that you probably been buying products from your whole life. And so if the financials line up, if you like the CEO, if you like the forecast of the company in the future, it's probably a great company to get into if it's the right price. And so what I like to do is I like to use a website called qualtrim.com. It's only $10 a month. Honestly, the value for this is insane. I learned a lot from the owner of this website. Let me see if I can find him, because I always forget his name, but I learned so much from him. So I need to give him a proper shout out. There he is. Joseph Carlson. So here's his website. Here's his YouTube channel, guys. Wealth of knowledge. Guys, he's got a portfolio of $840,000 in his portfolio. And I don't think he does options. I think he just buys great companies. That's all he does, is from my understanding. So great as far as, understanding companies and valuing companies, great guy to follow. Great guy to follow. There's a reason why he has 457,000 subscribers. So this is his website. It's $10 a month. And in my opinion, it is worth every penny. Makes it very, very easy for anyone to invest. So right off the bat on Insights, you'll see the S&P 500. You'll see the most trending stocks. You can see HIMS is on there, SoFi. This is a great place to start if you're looking for companies that you can sell puts on. And so we'll come in here and we'll look at, because they're trending, another one is growth, okay? But if they're trending, there's probably a lot of volume going on here. So for example, let's look at, and depending on how much money you have in your brokerage account, you're probably better off with the cheaper stocks. SoFi is a huge one for selling options, okay, because it's only $14 a share. Rocket Lab might be a good one. Damn, it's up almost 10% today. Interesting. Might need to put that on the watch list. Let's look at this company, okay? So if we go look at our cheat sheet, and we need to do some research on this company because it's a fairly new company. So remember, we said strong and growing revenue. Let's see if this one checks the box. What do you have here? Strong and growing revenue. Okay, that's a good sign. And then you have high return on equity. Well, you can see earnings per share. You can see it's not a very profitable company. We don't know why. Okay, it is a new company, but it has no free cash flow. It just has promising revenues. It's not a profitable company. It has no profit margin. This is probably a company that might be one of those early, I don't know anything about it, but I guarantee you if we do some research, and I'm going to write it down, some deeper research, This could be like a Palantir or something. And I'm not saying it's similar to that company, but it could be, as far as growth, a company that's not profitable yet, but has a lot of promise. And that's why it's trading with an $11 billion market cap. All right. So here's like a brief explanation of it. You definitely got to do better research than this. And one of the ways that I do it is go look at the transcripts of the earnings calls. But I also watch a bunch of YouTube videos on it and stuff too. I go and look at what social media thinks about it, because it matters. Shares of companies within the broader industrial sector are trading higher amid overall market strength following softer than expected April and blah, blah, blah. Okay, so again, I'm not quite sure. This tells you competitive advantages. This tells you the investment risk. You can see analyst estimates. So the industry is aerospace and defense. So I can go to the website. I can learn about the company. But it seems like it was close to Palantir type of company, and I didn't even mean to do that. Employees is growing. It's probably a company with a lot of promise, but there's an opportunity cost here. If you like it, you could probably, at $11 billion, this company might grow to $200 billion, in a few years. Who knows? It's probably good to watch this company and learn about the company, because this might be a future opportunity. All right. It's trending for a reason. But let's go to an actual company that's worth looking at. So this is Microsoft. $450 is too much. Let's go to SoFi. So this is the company that I just sold puts on. You guys can see the price is down from January to $14. The low this year was about $10. Okay. My strike price that I locked in is at $12.50. So, it could easily drop below $12.50 in the next month or so. But it has. But I think it's a bullish market right now, especially after all the news that we've seen. And I don't think momentum's gonna stop in the next 30 days. It could, but do I think it's gonna go up and maybe drop below $12.50? Probably not. That's my bet anyways. And there's an 80% chance I'm gonna win this, just based on the delta that I chose. But if you notice, it checks the first box. Revenue is crushing. Members. This is a KPI. The members continue to grow. It is a profitable company. Look at the EBITDA. Free cash flow is growing. Let's look at it from a quarterly basis. Okay. You guys can see it had one strong quarter, but it's almost there, right? Remember, this is a tech company, so we're not that worried for a tech company this new to be profitable. But if it continues these revenues, it's going to do great, because look at the net income. Net income's $500 million. What did it do with its free cash flow? I mean, what did it do with the net income? We can look at expenses and we can see marketing was $800 million. R&D was $550 million. OPEX was $600 million. That's what G&A is. CapEx was $154 million. Okay. So a lot of money in research and development. That's a good sign of a growing company. And I know a lot about this company. I know the CEO. I think this is a great company. This is another good sign. Employees are growing. Another good sign is if they're buying back stocks, they're not. They're a new company. So not a new company, but they're raising shares because, well, they're growing the company. Let's look at their cash and their debt. You can see their debt is $1.78 billion, but they have $2.5 billion in cash. They can pay this off right now. If they didn't have enough cash to cover this, I would look at how much net income they have, and they would be able to pay this back in the next few years. So I'm not stressed about the financials of this company. The profit margins are okay, but there's a lot of potential. This is a $15 billion company. This can be a couple $100 billion company in a few years. Damn, it's dropped to $14. Now I wish I would have sold some puts later on, but it's all good. I think I'm good no matter what. We remember $12.50 is the strike price. So in the next 30 days, will it drop before that? And even if it does, can I maintain above $12.50 the next 30 days? I think I can. I think I can. Okay. So if we go back to our checklist, well, we know there's consistent profit margin. We know there's high return on equity. We know there's low debt relative to cash flow. We know that it has brand strength. The economic moat is there as well, because they're a little bit different than what Robinhood is doing. One of the things about SoFi is that they have a deeper connection with their clients because they're more so a bank, and a lot of their clients have loans. with SoFi. So they're not going anywhere. And then the CEO is amazing, excellent leadership and culture. So I'm good with this company. It checks all the boxes. So I reviewed the financials, the balance sheet. Now, the way that I do the balance sheet, because this is the cash, this is not the assets under management. This is cash. Here's the thing though, SoFi is not like the type of company that's gonna have a bunch of inventory and assets under management. So I'm good with just seeing this, how much cash versus debt. Altogether, this is the balance sheet, okay? So this looks good as well. Now, if it was a company like, let's say a Zara or what's that furniture store? IKEA, right? I would want to know what AUM is. So I would just go to ChatGPT and I would do something like this. What is AUM of IKEA? Let's see what it says. ChatGPT is a game changer. So it says it doesn't publicly disclose this, okay? But total assets or whatever is 22.5 billion. This is probably wrong, okay? Tell me about their balance sheet. It'll probably even pull up the balance sheet. Sometimes when a lot of stocks get overlooked because a lot of people don't check the balance sheet, all right? And so here you go. Here's the balance sheet. You can see total assets, fixed assets, and then you can see the total liabilities, right? And so this company's definitely in good standing because the liabilities do not outweigh the assets, all right? And you can even click on here. It'll take you to the actual website. So shout out to ChatGPT for making that happen. All right. Once you've discovered that it's a good candidate and it passes all of these check marks, we'll go to valuation basics. We're going to look at intrinsic value versus the market price. You got to understand that what the company is worth versus what the market price is can be completely different. The market price could be cheap, could be lower than what you think it's valued at. So again, price is what you pay, value is what you get. And so intrinsic value is what a business is actually worth based on earnings, cash flow, et cetera, and the balance sheet, right? Market price is what people are willing to pay today. Sometimes a tweet could be the reason why a stock goes down, but it's worth way more. Sometimes rumors that you knowing aren't true because you use the product, right? Or you use the service, or I don't even want to say that, but you get what I'm saying. So anyways, you buy when the price is less than value. And you can do this also with the S&P 500. You can do this also with indexes, with the QQQ. You can do it with those. You can look at PE ratios for those. And if the PE ratio is low, you might want to buy it. Or you can also look at the earnings, the EPS, the earnings per share of that index, and match it with the price of the stock. And you might see that the index is worth a lot more than it's priced at. So when you see something's undervalued, you sell puts when the price is around the value and you're okay owning it. The reason why is because we can always, let's say it's right at a fair value. Well, we're going to put a strike price that's well below the fair value. That way, if it does dip by a little bit, we're still going to collect the premium. This is why it's important to understand what the value of that company is. So you can use Qualtrics valuation summaries to compare historical earnings versus market price. Look for fair value discrepancies. I'll say this too. Sometimes, even if it's overpriced, if you see something is trending and people are constantly talking about it, social media is a good indicator that Wall Street doesn't pay attention to. And it gives small investors like us a bit of an edge. If something has a shit ton of volume, bro, it doesn't matter if it's fair value or if it's overpriced. Chances are it's not going to go lower in price. We've seen it a million times. And one of the ways you can do that as well is using Google Trends. So Google Trends is a great way to see, how much volume a certain stock is getting. So like let's do SoFi stock. And let's see, so you guys can see the interest right now is pretty damn high. It was at its highest right here. Oh no, this is May. Let's look at not the past day. Let's look at the past 30 days. So it's pretty high right now. SoFi stock, right? Here, it wasn't that high. Here, it's very high. So we know there's a lot of interest in it. I think that's a good indicator. Again, these are just add-ons, just to make you feel like you have even more conviction. So Google Trends is definitely a tool. There's a guy, I don't know if you've seen the YouTube channel called Dumb Money. I would definitely recommend go checking out that YouTube channel. All he does is social arbitrage, is what he calls it. And let me show you that YouTube channel. So this YouTube channel right here, Dumb Money or Dumb Money Live, they have a regular channel as well. Bro, this guy right here has made millions. All of them are millionaires on this channel, and they just did it through businesses and investing, just like I'm showing you guys now. So I highly recommend you guys check out their channel, and I'll react to a lot of their videos as well, just because they're so insightful. They make investing so fun. Okay. Now let's actually start trying to value these companies, because it's cool to look at the financials, to look at a company and see that, hey, this is probably a good buy. But let's actually understand how to value a company. All right. So in this lesson, we're gonna learn how to use PE ratio, growth rates, and free cash flow. So PE ratios are price to earnings. It tells you how expensive the stock is compared to its earnings, compared with industry peers. Okay. So when you're using PE ratios, you don't match a PE ratio from, let's say, Nike and compare it to Nvidia. They're completely two different industries. They're going to trade with different PE ratios. All right. You got to do it closer to apples. So you could do Nike with Skechers if you want to. It doesn't have to be exactly the same. It just needs to be in the same industry. There's people who would even do Nike next to Gap, the Gap, for example, because it's in the consumer retail clothing space. All right. Another one you can use is PEG ratio, which is PE divided by growth rate. This adjusts valuations based on growth. So under 1 equals likely undervalued. So for regular companies, regular industries like Coca-Cola, Nike, stuff like that, we're going to use PE ratios, okay? But for tech companies, growth-based companies, new startups, like new companies that are growing, we're going to use PEG ratio, because these companies are priced based on their future, all right? Free cash flow is the cash left after operations and investments. So consistent free cash flow equals strong financial health. Let me show you what that looks like. I think Amazon has some really good free cash flow. Let me just make sure. Well, right now they do. So let's take a look at Amazon on this screen. So you can see their revenues is consistently growing. Their EBITDA, which is their earnings before interest, taxes, depreciation, amortization, that keeps growing. They had 2 down years with their free cash flow, but you know that after your EBITDA, after your net income, what's left is your free cash flow. And free cash flow is what's left that you can give back to the investors in the form of dividends. You can use it to buy back shares, right? There's all kinds of things that people can do with the free cash flow. This is a good sign of a healthy company, especially if it continues to grow. Sometimes that's annually, but sometimes you want to look at this quarterly just to see how it's probably going to do next month. And sometimes there's a pattern here, and it's based on seasonal things. Okay, so you got to look out for that as well. That's free cash flow. So what I like to use Qualtrim for this is to visualize the historical PE and growth trends and dive into the FCF breakdowns in the financials tab. And so, like, if you really wanted to look at the free cash flow, we can go deeper in here and we can just chat GPT this. And this is why, guys, I create a watch list. You don't need to know every stock in the world. You just need to know a handful of stocks really, really well. And then just keep selling puts on the same stocks. Okay. And so just like that, by ChatGPT, we can come in and we can get a better idea of what is going on with the free cash flow. All right. Strategic, all that good stuff. This is the type of research you want to do on your favorite companies. Cool. Now, I've shown you guys how you can go directly to a company's website and find a lot of their financials by going to the investor relations tab. Let me give you an idea of what that looks like from a different company. So like even your favorite brands like Home Depot, this is Home Depot. If you scroll all the way to the bottom, you'll see investor relations. And Here you can learn a lot of a lot of things about the company. You can see all their financial reports if you wanted to. It's always good to double check because you never know how these third-party websites are pulling their data. Sometimes the data could be wrong. So it's always good to just in case check that out. But you can also chat GPT their financials as well. Now, I like to use things like Qualtrim because it's a one-stop shop for all my financials and it's quick. And so I can quickly look at things. And then when I see something nice, then I can go do deep dives. You can go to sec.gov or directly to their website to find the 10Ks and the 10Qs. Seeking Alpha to listen to earnings calls, but Qualtrim allows you to do that as well. I told you guys if you go to Qualtrim and you go to transcripts, we can go to Home Depot and it'll use AI and you can just kind of read what the last one was, but you can do full transcript here. I like to, let's say I look at the transcript summary and I like what I see here, then I'll go actually listen to the call. I'll actually go listen to it. All right. If you want to go actually listen to it, you can use things like Seeking Alpha, but a lot of times it's on YouTube or on their website as well. Guru Focus is cool. Go check that out on your own time. A lot of cool metrics on there. FinViz is great. It has like a filter to find good stocks, and I'll show you how if you need a free filter, I think FinViz has a free filter, and we'll talk about filters in just a bit. Okay, and so here's Buffett's principles. Simple, understandable businesses, a strong moat and pricing power, consistent earnings and strong return on equity, fair price and long runway for growth. A lot of this stuff is common sense, guys. It doesn't have to be that hard. All right. And so here's your checklist. Number one, you want to evaluate the company quality. Number two, you want to compare the intrinsic value to the market price. You want to look at the PE, the PEG, the FCF for valuation clarity. You want to review the long-term financials on Qualtrim or whatever resources you can find. And then you're going to decide, are you going to sell a put on it or are you going to wait for a better price? Do you want to buy the stock directly? It's up to you what style you do. I don't buy the stocks directly right away unless it's like an obvious no-brainer, a slam dunk. I don't do that. I usually just stick to the blueprint. Base, sell puts, sell covered calls. Flywheel. That's what I do. Okay? But you should still know how to analyze companies and value them. Okie dokie. That was module 7. I hope that helps you guys. Let me see if there's any questions here. Yeah, so I'll show you in just a bit, Leo, some small caps. Fubo and Honest are up 10% since the last time we were talking about them. Everything's up 10% right now, Leo. Everything. I'm looking for stuff that I like that's down because that's what I'm trying to sell puts on. Have I looked at Square? Oh, I love Square as a company. I've not looked at their financials in a while. That's a good question. We can check out Square. You guys want to do that while we're here doing this? And then Joel asks, should I move my savings from my money market to a brokerage? What I recommend is you start from square one. If you're just catching this course now, go look at the first part of the live stream. If you go to my main channel, you'll see clips of each of the sections. I haven't broke it down into lessons, just like a course. And what I do is I move a certain amount of my savings to my brokerage. And then from there on out, my brokerage account is my savings account because I collect 4.5% interest. And it just makes it easier to go ahead and invest rather than having to transfer money from your savings, wait 5 days, and then you can invest. But then by then you missed out on a whole bunch of profits, right? Okay. Now, before I go look at Square, I have it written down. I want to show you guys, I showed you guys how to analyze a company, right? Now, and how to do like a brief valuation of a company, but let's really value these companies now.